Hello, active traders, and welcome to How Stock Traders Can Make the Jump to Forex Trading. This is Ken Calhoun. I run Day Trading University, and I'm joined here today by the world's top Forex coach and mentor, Peter Bain from ForexMentor.com. Peter, it's great to have you here with us today. Hello, Peter.
Hello, Ken.
Yes,
yeah,
hello.
I'm here. I'm sorry I missed your intro. I was getting set up for my presentation. Sorry about that.
Oh, sure thing. Well, welcome to the session, and welcome to all of our traders here. We've got a big turnout, so it's great to see so many of you here. Peter and I have co-produced the best-selling Forex Success Mastery System. We've got a little bit more on that later, but the main purpose of today's session is to teach all of you who are new to Forex trading some of the benefits and similarities for how to go from stock trading to Forex trading. As always, all information is for information or educational use only. We're not making advice nor recommendations about what to buy, sell, or hold. So let me, with that, go ahead and turn it over to Peter Bain. Peter will do the first half hour, and then I will do the second half hour. So welcome to everybody, and welcome aboard. Thanks, Peter.
Okay, Ken, if you could just let me know if you can hear me and see me, I'll get going here.
Yep, everything looks great.
Okay, thank you very much. And thanks to our audience participants for joining us on a Saturday. Ken and I appreciate your attendance. And I'm going to kick off here for the first half hour talking about stocks versus the Forex. I got into the Forex by happenstance a number of years ago, and I'm going to talk about that momentarily. This is Peter Bain of ForexMentor.com fame, and my experience with the Forex goes back to about 15 years ago. I was probably one of the first entrants to the Forex after it was deregulated in 1998 or so. I was involved with stocks and commodities, and happily so. Liking to write, I wrote a book about my experiences. I'd heard about the Forex, but thought it to be over there somewhere, a total mystery to me, something that perhaps required superior intellect and that was available only to a select few. I didn't give it a second thought. I was happy with my stocks and commodities. Then, out of the clear blue, I received an email from a trader in California who had bought my book. He indicated that the strategies I wrote about in my book worked better in the Forex market. I gave it a try, and lo and behold, he was right. It became abundantly clear to me rather quickly that there were a myriad of good points about the Forex that were hitherto unknown to me. Lightning fast deal execution and response time, no gaps, price certainty, no price shading, reduced slippage, trends that hold, and so on. As a matter of fact, at last count, there were at least 17 points favoring the Forex. So let's go through them. The Forex is a seamless 24/6 market. You can't trade it on Sunday, but you can trade it around the clock during the rest of the week. Low cost of entry, I'm going to talk about that in a minute. Reduced slippage. This is a good one, up to 400-to-1 leverage. Free execution service. When I first got into the Forex some 15 years ago, it was doing about 2.5 trillion, and it's now at 5.3 trillion and growing every day. It's just a vast market. Split-second response time. In the stock world, you're dealing with over 7,000 stocks that you have to pick and choose from in terms of what you're going to trade. In the Forex market, you have a choice of anywhere from 25 to 50 pairs. On the platform that I use, it's 28 pairs. Real-time profit and profit and loss analysis. The Forex is the largest and most liquid financial market. It's the best market for technical traders. And that's because when a currency trends, it trends well. No price shading as with phone trading. Instantaneous deal execution and price certainty. The Forex is 30 times the volume of all U.S. equity markets. It is 50 times larger than the New York Stock Exchange. No clearing costs, no commission costs, no transaction costs. Some of the world's best money makers are currency traders, namely George Soros, Bill Lipschwitz, I think I got his name pronounced right, and Bruce Kovner. You should, when you get a chance, Google Bill's name. He's got quite a story to tell. A good read. Now let's get back to the low cost of entry at the top. The minimum deposit to get going with a Forex trading account is 100 euros or a little bit over $100 US. That's as of yesterday. In some instances, you can get going with 50 bucks or 100 bucks. Can't do that in the stock world. The Forex is an electronic medium. It is not a building or an exchange. Trading begins in Sydney and ends in Sydney, Australia that is, around the clock. There's no need for you to sit at your computer all day trade hunting. There are 6 times of the day when trading opportunities occur every day. This is where the money is. This is where swings normally occur. I'm going to go through them now. You might want to write these down, so I'll go through these slowly. The biggest one is at 3 a.m. Eastern Time. That's the London Open. New York opens up at 8 a.m. Eastern Time. London closes at 11:30 a.m. Eastern Time. New York closes at 4:30 p.m. Eastern Time. Tokyo opens up at 7 a.m. I'm sorry, that should read 7 p.m. Eastern Time. Sorry about that. And Singapore opens up at 9 p.m. Eastern Time. Again, Tokyo at 7 p.m. Eastern Time. This is where the money is in the Forex. This is where the market swings occur. If a trader is trying to trade hunt at 2 o'clock in the afternoon, he's going to be sorely disappointed because nothing happens at 2 o'clock in the afternoon. There's something here for everyone, no matter if you have a day job or where you live on this planet. It probably makes sense for you to specialize in one market turning point that works for you. At any market turning point, you will probably find more than one pair that swings at that point, more money in your account. Translation: the Forex is an easy market to trade. All right, let's have a look at these market swings. Here is the dollar CAD 5-minute chart. You'll notice price cycling lower, MACD waving higher. That's called positive divergence on MACD to price. This presages a swing point. Price is going to swing here, and it's going to swing at the New York close at 4:30 p.m. Eastern Time. This happens every day. So if you're a swing trader, this is a great market to trade. This is the euro-dollar 1-hour chart. As a matter of fact, this is as of yesterday. Here you have price cycling lower in the form of a downtrend continuation pattern. It's one of the patterns that I talk about all the time at forexmentor.com. This is really the end of the run. At the end of that pattern, you'll notice that MACD went oversold and then punched up through its trigger line. That's a buy signal. We're at a swing point, and this turns out to be the New York close yesterday at 4:30 p.m. Eastern Time. After that swing point, price did an uptrend continuation pattern. So we had two patterns back to back. Once you know how to read these patterns and you see them unfolding, you know exactly where price is going to go. So we got into this trade right here at the New York close, and we're going to get out right here because this is the end of the uptrend continuation pattern. And then price fell off, and getting out of that trade was confirmed by MACD punching down through his trigger line. Price then formed a downtrend reversal pattern, and the reason I knew it was going to be a downtrend reversal was just by looking at MACD, because MACD went oversold below the waterline and then punched up through its trigger line. So price went down. It slithered sideways in the form of price equilibrium or consolidation. Translation, traders chopping wood. Good place to enter a buy right here because MACD indicated that that was the thing to do. So we're in here and we're out here. Actually, this was the end of the uptrend continuation pattern, but it's wise to stay into a trade as long as MACD is above its trigger line. So this is the jumping off point right here because MACD is punching down through its trigger line. Here we're looking at the dollar yen. This is a 5-minute chart. Price swooned into a price exhaustion hammer or price rejection hammer, which denotes that we're at a swing point. MACD going extremely oversold. It then punches up through its trigger line, bounces off its trigger line, and continues on up. This is a good entry point for a buy right here. A good swing point occurring at the London close, 11:30 a.m. Eastern Time. This happens every day. Looking at the pound CAD 5-minute chart, price cycling lower. We have a price exhaustion or price rejection hammer. MACD going oversold, punching up through its trigger line. It's above its trigger line at this point. This is the entry point for a buy because we're at a swing point, which happens to be the London close. Price swoons over here. Again, we have a price reversal candle. MACD going oversold, punching up through its trigger line. This is a good entry point to the buy side right here, and you can see that. Whenever you see MACD doing this, where it goes extremely oversold in this case, you know that in this instance you're at a good buy point. Another example, this is the EuroCAD 5-minute chart. You can see price swooning. Again, we have a price rejection or price rejection candle right here. All the while MACD going oversold, punching up through its trigger line. It's above its trigger line. This is a buy point at the London close on this particular day. Another example, the Aussie dollar 5-minute chart. Here we have price tanking, again price rejection or price exhaustion in the form of a turnaround candle. MACD oversold. We wait for MACD to punch up through its trigger line, and this is where we buy because this is a swing point at the Singapore Open. This is 9 p.m. Eastern Time. We place our stop 20 to 30 pips below the buy. Price advances and then declines to test our buy point, but we're not worried because our stop is 20 to 30 pips southward. MACD bounces off its trigger line. Price advances above the number 2 point of this 1, 2, 3 bottom. You can see that right there. 1, 2, 3. That's a 1, 2, 3 bottom. And normally what you do is you buy on a break of the number 2 point right here. So we bought back here. Our stop is down here. We're going to hold that buy. No need to get out of it. And we're going to buy again right here, placing another stop 20 to 30 pips below that buy. So we've got 2 buys in play following the swing point at the Singapore Open, 9 p.m. Eastern Time. Good idea to hold those buys. Okay. Here you see the 2 major markets in the Forex, the Tokyo session and the London session. You can see that the Tokyo session is predominated by the dollar-yen. The London session is predominated by these 3 pairs. That said, I've done very well over the past 10 years with the dollar CAD, which only occupies 5% of the London pie. Here you see the various sessions for the Forex on the left, and you'll notice that when the London market opens at 3 a.m. Eastern Time, this is when the Forex is busiest. And that is why the London Open is the busiest and best time to trade the Forex, although it depends on where you live on this wonderful planet of ours. I'm on the west coast of Canada, which means that the London market opens at 3 a.m. Eastern Time, which is midnight Eastern Time for me. I used to stay up for this market for many years, but don't anymore, because once you're into this market at midnight, you have to stick with it for a while. Okay, on the platform that I use, there are 28 pairs listed here on your screen, versus the stock world where you have over 7,000 stocks to contend with. So you only have to go through 28 pairs on my platform to find a trade or trade. It's not a big deal. It doesn't take very long the way I do it. Okay, which charts should you use to trade the Forex? All charts obviously come from the same data feed. There's a daily chart, 15-minute chart, 5-minute chart, and the hourly chart. I ignore the 15-minute chart because I want to work with the daily, hourly, and 5-minute. I'll show you how that works right now. Okay, for day trading, I use the hourly and the 5-minute chart. The hourly chart tells me the trend, and the 5-minute chart is the trigger chart. Let's have a look at this. This is the dollar-yen hourly chart. You'll notice price above both moving averages, the 200 and the 50 exponential moving averages. Same day, same time on the 5-minute chart, same pair, prices below both moving averages at this point. This is a buy. This is called a shotgun trade. It's buy number 1. This is buy number 2. Price falls below both moving averages again, right here. all the while price is above both moving averages on the hourly chart. Another shotgun trade. Scalping. I don't have time to get into scalping today because I'm short of time. I'm actually running over my time. But for scalping, I use the 5-minute chart and I plot, plot Bollinger Bands and RSI. Now for position trading, using the same data feed, I use the hourly chart and the daily chart. The daily chart tells me the trend, and the trigger chart is my trigger chart. That's the hourly chart, is the trigger chart. So look at an example. This is the Aussie daily chart. You'll notice price trending up above the 50 exponential moving average. MACD above its trigger line, above the water line, trending up. The trend is up on the Aussie daily chart. You'll notice on the Aussie 1-hour chart that price in this instance is below the 50 exponential moving average, whereas it's above it on the daily chart. This is called the trigger chart on the higher level charts. Price advances, and again, 3 good buy points because price was below the 50 exponential moving average, all the while it was above it on the hourly chart. You'll notice the absence of price movement in here. This is the weekend. This is the Sunday of a weekend. There's no Forex activity on Sunday up to later in the afternoon. Okay, so to trade the Forex, the way I do it, I only use the daily, hourly, and 5-minute charts. 3 charts. Now, what type of equipment do you need to trade the Forex? I'm going to have a look at or show you, pardon me, while I take some nourishment here. I'm going to show you some examples of equipment used by our members at forexmentor.com. Here you have somebody who has the dealing window here, and perhaps the daily here, the hourly here, and the 5-minute here. So he can position trade here, and he can day trade here. Same idea here. He's got the daily, hourly, and 5-minute charts. You'll notice on his wall a wall chart pattern chart. You can get that by going to www.chartpatterns.com. Here's one of our younger members. 3 screens. There's his dealing window right there. And he may have the hourly and 5-minute here, or the daily and the 1-hour here, depending upon whether he's position trading or day trading. Another configuration, wall-mounted screens. Four screens mounted on this person's desk. You can see how the mounting occurs with this brace here. This individual has 6 screens either mounted on the wall or attached to his desk. I can't figure out which way. Probably he has his dealing window over here. He or she. You can get really carried away with screen configurations. It's not necessary. Here's an individual at street level using an outdated technology, 1 screen. And of course, you can trade the Forex anywhere that you have a computer and an internet connection. One of our better traders trades only using a laptop and a satellite connection. She has a success rate of around 90%. This is not her, this is just an example. She trades only one of the 6 times that I mentioned before, the London close. And you can see why. Again, her success rate is 90%, which is unheard of in trading circles. Now, indicators, I like to avoid chart clutter. I like to keep my screens clean. However, I do plot some indicators. For day trading and position trading, I plot MACD, 50 EMA, and 200 EMA. For scalping on the 5-minute chart, I plot only Bollinger Bands and RSI. I'll talk about scalping some other day, some other time. So I only use 5 indicators of the many that are available to us. Now, hopefully you're taking notes. And a question that I'm asked quite often is, what are your settings for these indicators? I just use standard settings. Okay, that said, price is the #1 indicator, and that's a topic for another time. But the reason I like to keep my screens uncluttered as much as possible is because price is the #1 indicator. It leaves clues. It tells you exactly where it's going. There are 4 price patterns that I use that tell me where price is going, or let me know where price is going. And again, that's a subject for another day. Clean screens is the name of the game. Now, I am getting close to the end of my presentation, but I wanted to talk about a very important information called commitments of traders, which is a good proxy for the Forex. It's futures data, but I use it for the Forex as well. Now, at the service that I use, Barry plots commitments of traders data for 66 odd asset classes, and you'll notice that all the asset classes are listed together. Pound sterling, rough rice, S&P, stock index, US dollar index, and so on. They're all mixed in together. Currencies are just another asset class. The nice thing about trading the Forex is I can have a look at all the currencies to see what the big dogs are doing, what the institutional traders are doing with each currency. You can't do that with the stocks. There are just so many stocks. You can't see what institutional traders are doing for each stock that I'm aware of. Stand to be corrected on that, but that's my information. Today, I want to talk about a very important asset class, the euro. You'll notice that the big dogs data is plotted or graphed 2 different ways. Up here, we see their positions graphed so that, or plotted so that you can see the positions in relation to the waterline. Back in May, they started accumulating the euro. As the price of the euro was falling, they were buying, accumulating positions in the euro. They're not day traders, they're position traders. In other words, they want to accumulate positions with a view to where a currency is going to be, say, 3 months from now. The euro has really been in a free fall. That same data is shown down here a little bit differently. You can see the commercial traders or the big dogs. This is the orange line here. The hedge funds, the green line. The street money, those with $5,000 in their account, usually follow the hedge funds. The hedge funds trade on the basis of they stay in a trade as long as their computers show what the trend is. The trend on the euro being down for the past, well, since May, at least May, the hedge funds have been short as price has been following. The big dogs, conversely, have been buying. They're contrarian traders. And these are the guys that I watch, because this is the divergence that I look for, which tells me that the euro is about to or should turn the corner sooner than later. And I've been saying this for quite some time now. Ken will vouch for me on that. Well, who could have guessed? We've turned the corner on the euro. Back here in October, early October, we had railway tracks. Price closed down, price closed up. That's called railway tracks or tweezers in the candle world. This is a futures chart that we're looking at. The futures chart and Forex charts move in tandem. That's futures, this is Forex. Same thing happened here in the Forex arena. We had price cycling lower, as I indicated. MACD well below the waterline, oversold. Then, lo and behold, we had what I was looking for all along, railway tracks or tweezers in the Forex arena. A nice swing point. The euro has turned the corner. Now, this would be a good time to buy as far as I'm concerned, because MACD is below the waterline, it's above its trigger line, trending up. But in true technical trading terms, you should really wait until MACD closes above the 50 exponential moving average, and the 50 exponential moving average flattens out and turns up. That is the true definition of trading when a pair turns the corner like this. But we're seeing in the futures world and the Forex arena that the euro has in fact turned the corner. I was taken to task by one of the members at Forex Mentor in terms of, well, does the commitments of traders data really work, and should we really believe it? Well, seeing is believing, and I guess I was right. I usually am, because I'm not a genius. I just follow what the big dogs are doing. I look at their data every Friday when it comes out. Now, let's have a look at the dollar, as a number of you in the audience will be Americans, our beloved Americans. You'll notice with the U.S. dollar, this is a real wowee. U.S. dollar rising, commercial traders selling. They're contrarians, as I said before. All-time short on the U.S. dollar. You'll see in this depiction over here, commercial traders short the dollar, hedge funds long the dollar. Although that's changing. The commercial traders have gone from being short to starting to cover their shorts. The hedge funds are starting to take notice. Their computer systems are telling them that something's happening, that U.S. dollar is topping out and going down. So that's how they trade. They go from being long to short. I can't show you anything in the Forex world because the U.S. dollar is not shown as an asset class in the Forex arena, because all of the currencies are paired with the U.S. dollar. This is a futures chart, a daily futures chart as of yesterday, close of business. And you'll notice there's our railway tracks on the U.S. dollar. They're actually not railway tracks when you're looking at bars, but if we were looking at candles, these would be tweezers. We had price close up one day, close down the next. This is called price exhaustion or reversal, which means the price has nowhere to go but down, and you can see that the U.S. dollar is falling, as confirmed by MACD punching down through its trigger line. Good gap between the MACD and its trigger line, moving down towards the waterline. Now let's have a look at the S&P 500. We're all aware, or I'm sure you're aware, that the markets have been declining this week. Commercial traders, short, but not extremely so like they were back here. Basically short below the waterline on the S&P 500. Over here, this chart really tells me that it really doesn't tell me anything. It tells me that the commercial traders are basically short the S&P 500. The hedge funds are basically long, but I don't see that real big divergence that I look for that tells me that we're at a market top. So let's go to the data. Data doesn't lie. And let's have a look at what happened yesterday. This is a futures chart for the S&P 500 as of yesterday. Very interesting. If you're a futures trader, you'll know what I'm talking about. Yeah, we've had a fall off in the S&P 500. Everybody knows that. MACD singing the same song, well below the waterline, below its trigger line. But it's turned up. RSI is turned up, but it's still below the all-important 50 level, as Ken will attest. Now, you see this gap in here. Usually in the futures world, this gap gets filled, and lo and behold, it did get filled by these two candles, and more importantly, this one here. You can see that it looks like we may have turned the corner, that the decline in the S&P 500 may be over, although I don't like to guess. I need to see the MACD red line turn up further and punch through its trigger line before I declare a bottom on this rundown in price on the S&P 500. Where's the money in the Forex? I preach this all the time to our members. 20 pips a day in a standard account adds up to $4,000 US a month, which is more than most people make in their day jobs. Your goal in trading the Forex should be 20 pips a day, which is $4,000 per month US. This is if you trade the way I've been telling you to today, achieving 20 pips a day is totally realistic. Achieving a goal of $4,000 a month is totally realistic. I mentioned a kind of interesting comment here. I was dealing with a fund manager here in Victoria, British Columbia, which is where I live. And I told him about this, and he was about to retire at the time I mentioned this to him. And he was all excited because he said, you know, when I retire, if I can make $4,000 a month, I'm pretty excited. I'm pretty stoked by that because with my pension, $4,000 a month with my pension is not too shabby. So I think I had a convert. Okay, the good news is that's the end of my presentation. I'd like to thank you for your time. I hope this has been instructional for you. And on that note, Ken, I'd like to turn it over to you.
All right. Well, hey, great job, Peter. It's always good learning new strategies from you. And for all the traders who are watching today, I hope that's been an eye-opening introduction to some of the benefits for how Forex works and some of the differences between that and stock charts. Now, in my portion, we're going to be looking at differences between current market stock and Forex charts for how that works. And for those of you, main goal is to help those of you who are currently trading stocks. I trade multiple markets myself, but for those of you who only trade stocks or primarily trade stocks or E-minis, it makes sense for you to add to or at least test out trading the Forex to what you're doing, particularly for swing trading. You know, one thing that I learned from Peter Bain, which he's absolutely correct on, as with everything he teaches, is, for example, using the, you may be familiar with using moving average lines. Well, here is the 50 and the 200 exponential moving average with the Euro CAD. And something Peter and I were talking about before tonight's, this afternoon's broadcast was the fact that Peter correctly identified that the Euro had punched up above the 50 EMA, and that's one of the type of things that you look for that you can take from your stock trading background and apply to the Forex. Peter, I don't know if you're still there, but I just wanted to mention that as a good example of the synergy of our techniques because you taught me. Thank you. I guess that's the first tip is if using simple moving averages from stocks like the 50, 100, 200 simple moving average, what Peter Bain taught me, and he's correct, is you should be using the 50 and the 200 exponential averages, and those make for much better signals for Forex trades. So that makes sense, right, Peter?
Absolutely. I'm with you all the way, Ken. I mentioned that in reference to the euro turning the corner to wait for a price to punch up above the 50 exponential moving average to get confirmation that the trend has changed and then that you should be buying.
Right, right. So good point. And I just wanted to say thanks so much to Peter Bain's the world's top Forex mentor. A lot of people have come along and copied and jumped into the Forex arena, but Peter Bain is the first and the original and the best of the teachers in Forex, just like Steve Nissen is for candlesticks. So it's a pleasure to be working with you, Peter. And thanks for that tip because it worked. It was a good one. So I appreciate the idea. It's very helpful.
You're welcome, Ken. Always a pleasure to be working with you.
All right. So traders, let's jump back into this. And what I wanted to share with you was kind of a game plan for making the transition from stocks to Forex. Now, here's an example of a real money trade I did in my Interactive Brokers account last year about this time. It was October 2013, up to almost 3,000 views, how I really trade Forex using Interactive Brokers. The good news is you can trade Forex on multiple platforms, and that's a live real trade example I did on my IB platform. You don't even have to, if you use IB, you don't even have to learn pips and lots. You can just trade the number of dollars of the base currency using the same exact approach you do in stock trading. So that makes for an easy transition. What I want to cover for you today, let me go ahead and throw up just a quick intro slide, how stock traders can make the jump to Forex trading. Peter Bain and I co-produced, so far best-selling. We've had so many dozens of sales of the Forex Success Mastery System together, and we've teamed up and did a seminar last year in Las Vegas, and that was very popular. We got all kinds of video testimonials, and the system that we created has been a bestseller over the summer when we just launched it. What I want to do today is teach you some of the differences between the stock charts and currency charts. And the good news is a lot of what you've learned in trading stocks is directly applicable to Forex. It's not like it's a mysterious land of wacky charts that are all different. Just the term of measurement or the unit of measurement is just in the base number of dollars or euros or pounds or whatever the base currency is. But the chart patterns are with very minor differences pretty much identical to what you look for. For example, one of my favorite patterns is what I call an acceleration ramp, and you can see that in the Euro-CAD. For those of you who have been in my breakout training, you know it's a steady slope of an uptrend followed by a sharp slope. The icing on the cake is when Wilder's average directional index triggers above the 30 moving average. And what you do is put in a long buy signal, say 30 pips above the high of the day in which that's generated. So here, ADX had been down here. How many of you, show of hands, have ever run into the problem of, let's say let me clear the lines here, of buying a false breakout? Let's say you drew a horizontal resistance line and you bought right there and get stopped out. You got bought there again, you got stopped out. You bought there again, he said stopped out. And then you said, the heck with it, I'm not going to trade that anymore. 3 times and I'm out. And then it runs up without you. Anybody ever do that? It's very frustrating. If you want to make money Forex trading, what you need to do, potentially make money, what you need to do is add what I call a false breakout filter, just simply using Wilder's average directional index, the ADX with a 14-step parameter, just have the red ADX signal. I do not use the plus and minus DIs, but here in the Euro-CAD, perfect example this week. My methods are robust. If you've tested them out for any length of time, you know they work. Here we have it's grinding down to finally, broke over 30 right here on this day. So you put a long trigger in above the high of the day in which that hit, which would get you in there. And again, here when the ADX broke over 30, and you're in the money. Ka-ching. What you're looking for in your Forex trades is using a simple ADX process. Now, in stock trades, I'll use a 40 MA or 40 ADX line. In Forex, I use a little more sensitive indicator like the 30. Okay. Now, one of the things you want to look for in your daily charts in terms of similarities, here is, for example, a 3-month chart in ED. Here's one in AR. One of the chart patterns that I always like to look for are not only moving average crossovers, but high volatility breakouts where something has just recently recovered above a major moving average. And my signature play, this one I've published on inequities.com and I've spoken on at the Money Show, and I've published on in Stocks and Commodities. I'm in this month's Stocks and Commodities November issue. The rest of it is a wide range candle at the right side of a cup. Okay, on a 90-day candlestick chart. That's easy. You can all spot that, right? What you do is you buy above the high of the candle. By wide range, I mean the whole real body has to be at least 1.5 to twice the height of the whole real bodies of the previous chart. So this is a stock chart, and you can see you buy a wide range above a wide range candle, say 50 cents or so, and we're off to the races. That's a nice classic Calhoun bullish cup with wide range candle breakout pattern. Well, what you'll find is in your Forex charts you see the exact same signal. So for example, here is a wide range, here's a cup with a wide range candle. We want it to climb over. In the euro dollar, I want to see it get back over, say 129.5 above that nearest 50 EMA, okay? And you're using that same exact extension process where you're looking for, whether you have tweezer bottoms or almost hammer type. That's not a hammer because the shadow appears too high, but bullish lower shadows telling you buyers might be coming in with an increasing ADX makes for a really obvious trade setup, right? Here we are. Here's that pattern with the Euro CAD. We have a bullish cup, a wide range candle. We wait for it to climb above, and this is a good practical technique, is wait for it to get above. If, say, wide range candle's right near a major moving average, don't buy right there because that's resistance. You wait until it breaks above it, and boom, you're off to the races, and you're in the money. So look for similarities of patterns in your stock trades to your Forex trades. Here's an example of the US dollar to the Japan yen. It ran all the way up to 110, right? If you look at the one-year chart, it's a rock star chart, right? The dollar yen started off down at 96, ran all the way up to 109. The two-year chart, even more price action from 77 to 109. What a run in the US dollar to the Japan yen. Well, let's zoom in. What's going on here? You've got a tweezer bottom at a EMA here at the 50 EMA, and what you can see is that that's likely going to produce a bounce here. Again, you look for a bullish cup to wait, say, 30 pips above 107.50 to get in on a continuous breakout for a pivot play. You don't want to go short in here unless it loses that support line. And what do you see here? This is test this out, okay? Test this out in your own trades. Wide range candles at the right side of a cup. That's my signature #1 favorite momentum breakout pattern in the Forex. In stocks, I like minor gaps that continue. Brings up a difference between stocks and Forex. Other than the Sunday, Monday, there's not much of a gap in the Forex, and that's a good reason to trade your currency charts because you don't have to risk, say in stock charts, you could have a big gap either for or against you in something that is gapped up or down. And, if it gaps in your favor, that's great, but if it gaps against you, if you've ever held into earnings release and seen, like I remember I traded Oracle once upon a time back in 2001, and I was long at 30 and I held it into earnings and it opened up at 15 the next morning and I took a bath. I lost, it was something like $600-700 on just a small trade. In a single trade, I lost close to $1,000 because of a gap against me. Now, currency charts don't make major gaps, so that's another big safety net for you as a swing trader, is you do not need to worry about huge gaps for or against you because you have kind of a continuous pattern, whether it's up, down, or sideways in whatever you're trading. So if you're going long in something like, say, the US dollar to the CAD, or I like the Euro CAD, come on, Euro CAD, nice uptrend continuation chart, you get a little itty-bitty gap like this, right? So over the weekend, you get a little tiny itty-bitty gap. Nothing to write home about. Another itty-bitty gap. You're not going to get some big 6-point gap that's going to cost you hundreds of dollars on an earnings release because you forgot to. How many of you have done that? You've held something in earnings release because either most likely you were too busy and forgot there's going to be earnings release, and it's come to find there's a huge gap against you, and it's really frustrating. With your Forex charts, you do not need to worry about gaps, and that's one of the major benefits. That is, from a risk management standpoint, which is key to success as a trader, you don't have to worry about huge gaps against you in your positions in Forex. So that's another good benefit. The other thing is you can also apply these same chart patterns, whether you're using daily candlestick charts for longer term swings or you're looking for, say, pivot plays like the dollar yen. It's done my classic, there is the long signal, say 30 pips above that wide candle high, ran on up. Here's a quick tip. First sign of an exit. Sometimes you will not see a bearish, this is a bearish engulfing right there, but sometimes you won't see a bearish engulfing or a tweezer top or a shooting star at a high. You'll start to see bearish upper shadows. a quick thing that you can use in Forex trades that I also use in my stock trades is 2 red candles in a row tells you that trend is done, stick a fork in it, close out the trade, or at least right under support, right? So you see 2 red candles following an uptrend. That's also similar to what you can find in your stock trades. You know, let's say here's one that ran up a lot lately, Lake, L-A-K-E, it ran up from 7 to 26. Well, that's kind of risky to trade. What if you bought 27 and now it's at 8.17? It's kind of frustrating. 2 red candles, sure enough, portends a downtrend. Well, without all that drama and risk, you can much more tightly trade your currency charts using that type of pattern. So my message to you is that you can apply a lot of what you've learned in stock trading to Forex trading, but do so with potentially much less risk because you do not face overnight gaps against you. It's kind of like a long continuous string chart. It's one of the reasons why I like swing trading the Forex. Also, you know, in case you hadn't noticed, our S&P just took a nosedive the last couple of weeks. It's a good technical term, a nosedive. More technically, what I've been telling all my traders, thousands of traders about is, if the S&P loses the 200 moving average line, watch out. And it just did that for the first time in years. S&P got a hammer there on the 2-year, but the main thing is you just lost the major, on the 1-year, you see we just lost the major 200 moving average, and that's a bad thing, right? Because for the last several years, the S&P has been a nice strong uptrend. This drop here is the most severe drop in 2 years. In fact, the Dow sold off to a 3-year price action. Most points sold off in 3 years in the Dow last week alone. That's going to spook a lot of institutional traders. And guys like me, I'm going to cash in my equity accounts and rolling capital into Forex accounts because this is and to my bear ETFs, my inverse ETFs, because this finally lost the 200 moving average line. So if you're a stock trader, instead of just standing clear and not trading anything, I would encourage you to consider trading your currency charts because they have very good volatility to trade, but you need to know the exact patterns in instruments that are most likely to move. So a few good reasons why you might want to consider adding Forex to your, especially swing trading approach as a trader. Make sense so far, everybody? You know, one of the things I had mentioned to Peter earlier, and I'll mention to all of you too, and I'd mentioned this in one of my previous webinars, I've got over 3,000 registered for my Saturday events, is that if you're not successful as a stock trader or not as successful as you'd like to be, you might find that you can do better as a Forex trader. You know, some of the world's top traders are currency traders. I trade multiple markets because if the market chops around, if the stock market goes sideways, you don't want to trade it, right? But there's always going to be some action in the Forex because the world's currencies are always in flux. So there's always going to be some action over in Forex that you can capitalize on despite a selling or a choppy stock market. So now is a particularly good time for you to get up to speed on how to trade the currency markets. And not only is the S&P telling you, that's kind of a warning, Will Rogers danger sign for those of you who remember Lost in Space. I'm a fan of 1960s TV. Shout out if you agree. Anyway, markets did a big nosedive this last couple of weeks, so it may not be a good time to be out there buying the stock market. It's been a nice run. Thank you very much. We may be in for what we saw earlier with a huge drop. That looks like it's about ready to fall off a cliff, eh? I mean, I don't know about you, but I am not trading the stock market long right now, not unless we break back over new highs. And for now, it looks like the market's done. Stick a fork in it. It may chop and grind into the rest of the year. So now I want you guys to start learning how to trade Forex and learn from the best, which is Peter Bain. And along with myself, you know, we put together the trading system of a lifetime. You know, and I don't just say that. Look at all the testimonials from everybody at the Forex Success Mastery.com site. And we do have a special deal for you, but before I jump into that, let me just ask Peter, if you're still there, any comments on, you know, the fact that, hey, the stock market looks like it's selling. Traders can potentially do better trading Forex using some of the same, with minor adjustment, patterns for entry and exit, the same technical patterns and trading skills. You just have to learn the differences between what's going on in the stock market and how to trade currency pairs, thanks to what we've got for you that we'll tell you about in just a minute. But any comments on that, Peter?
Yeah, it's interesting. There have been this past week a lot of oohs and ahs about the stock market falling off, and a certain degree of nervousness, and everybody's scratching their head like, well, what do we do now? Well, you made the comment, which is quite right, that the Forex market is always there. It's always in motion. It's a great market to trade. You don't have to worry about anything falling off the cliff because nothing ever does fall off the cliff. Well, it does, but for the Forex Mentor members, I always talk to our members about trading currencies to the long side just because it's easier to get that concept through. Yeah, there are currencies that you can trade to the short side, but the Forex market is an ideal trading market in that there's always action, and you're not worried about, like I said before, the stock market falling off the cliff, because nothing ever really falls off the cliff in the Forex market. You can be in there at all times trading any number of pairs and be doing very well because it's a great market to trade. Technical analysis works great because when the trend occurs in the Forex arena, it sticks quite well, it stays quite well, and so therefore you can, if you're trading an uptrending market, you can just buy the dips in the uptrend for quite some time if you're just patient enough to buy weakness and wait for a currency pair to go weak in an uptrend. That's my favorite strategy.
Yeah, and that's an excellent point. Is, if I were to have all traders start off trading period from scratch, I would have them start off with Forex as a minimum because it's easier to trade, because the markets, like you said, Peter, the trends are continuous, they're easier, it's kind of like a bunny slope, so you don't get whipsawed and moved around with a 15-point swing in a stock or a gap against you that's wildly expensive when you're wrong. It's much, from a risk management standpoint, it's much easier to trade our currencies because they move with much more gradual slope, kind of like a bunny slope. It's much easier. You could catch either dips in the uptrend or buy the breakouts like I do. Whatever you're doing in an uptrend continuation play or on a pivot, the trends tend to be much more gentle and much more consistent than they are in the equities market. So with the stock market selling off, the Forex charts a really good alternative for traders to start thinking about trading. And the good news is Forex trading is perfect if you're on a budget. It's not like, expensive day trading or expensive trading Apple or Tesla or Netflix or something. You can trade with a much smaller account size to get started. You can talk to your current broker or check into the multiple brokers out there and find out more about that. So, yeah, it's a good point. I agree.